Welcome, everybody. This is Buck Joffrey with Consensus Network. Today, I want to start out by reminding you that if you're starting to get really interested in this whole cryptocurrency thing, this distributed ledger technology and such, make sure to visit the website, consensusnetwork.io. And there's lots of tutorials there that Phil, my producer, has put together. He's done a good job on those, and it's sort of easy to get in. Still a good time to get in. We've got, Bitcoin as of this morning, I think was trading around $6,500. Not a bad time. Still, if you've owned nothing, I would seriously consider it. Obviously, we'll have the news to talk about those issues some more, but if you listen to last week's news and the week before that, you'll understand why I think that that's the case. Also, for those of you who are, Bitcoin rich, consider going to my other podcast, Wealth Formula Podcast, where we really are speaking to people who actually have money and what to do with it. And it's not just about investing, but it's also about tax mitigation, lowering your taxes. I've got some really good ideas on the Bitcoin front, by the way. And also on, things that people with a lot of money need to worry about, like asset protection, estate planning, etc. Again, that is Wealth Formula Podcast. It's been around for a while. It's a great podcast for people who are just interested in learning about non-traditional investing. We're really sort of a non-Wall Street show. I'm not a Wall Street guy, folks. So anyway, as for this week, I think this is an interesting show. On the news, and the last news that we had last week, I told you about how Yale University had decided to get into the whole crypto market through its endowment. And, of course, that's a big deal, right? I mean, you've got Yale, second oldest university in the United States after Harvard, and it is investing some of that endowment money into cryptocurrency. By the way, they're one of the most successful endowments out there in terms of percentage returns year over year. And so it's just another sign of the inevitability of this technological phenomena. Don't listen to Nouriel Roubini, who has predicted everything wrong, specifically on cryptocurrency for the last decade consistently. Now, the major universities have accepted this. We know that Wall Street has already looked at Bitcoin at least as a legitimate storage of value. Now, let's go back to the university thing. Again, this is kind of a big deal, right? Because, what do universities do? They're not Wall Street. They're trying to teach things that they think are the future. And of course, they want to make sure that their students are prepared for things that are coming up, right? Technologically, et cetera. Well, sure enough, because of that, you're seeing more and more of these blockchain and distributed ledger courses popping up in the universities left and right. You can also see online. I think MIT has something now. Anyway, lots of major universities are trying to, take advantage of this new revolution and not only teach people, but on the online side, understanding that people want to learn about it, they can make some money doing it too. Now, that doesn't mean they know what they're talking about necessarily, because I've listened to some of these folks and they say some things that are a little unusual for anybody who knows a little bit about blockchain distributed ledger technology. But one thing's for sure, I think they're really trying. Now, the University of California, Berkeley, in particular, a fine institution in the Bay Area, which is also helpful because so much fintech is going on over there. They've been on the cutting edge of many new technological and social movements. So in that regard, it's not too surprising that our guest on today's show, Greg LaBlanc, is one of the instructors on a brand new course that introduces Berkeley students to blockchain. Greg is a really, really smart guy, and he takes us from a unique perspective because he's also a financial historian. So when we come back, you're going to hear from Greg LaBlanc, Professor Greg LaBlanc, not only on his thoughts on Bitcoin and blockchain and all these things, but also how it fits into the big picture historically. Welcome back to the show, everyone. Today, my guest is Greg LaBlanc. Now, Greg is a lecturer and distinguished teaching fellow at the University of California, Berkeley's Haas School of Business, and also serves as the director of the Bolt Hall School of Law's FinTech Center. Okay. Greg's research and interest include work in data analytics, business model innovation, alternative investment strategies, evolutionary decision theory, behavioral law and economics, and behavioral corporate finance. He's also recently co-developed the first class offered at UC Berkeley on blockchain called Blockchain and the Future of Technology, Business, and Law. Greg, thanks for joining us today.
Thank you.
So you've got a really broad set of interests and expertise. So I have so many things that I'd love to speak to you about, but let's start with money.
Okay.
As a storage of value, and understanding that you have an interest in this from a historical perspective, as a storage of value and a way of transferring that value, what do you see as the major innovations and changes in those systems in say the last 100, 200 years that you think are the sort of the key moments, maybe two or three things that really changed during that period of time?
Boy, that's a great question. I mean, there's not a lot that's actually new under the sun. I mean, everything that we're seeing is kind of a newer version of things that we've seen in the past. Whether we're talking about a movement back to things like cryptocurrencies, which in many ways it's like going back to commodity money in some ways. We could talk about the importance of central banks, but we've actually had central banks and things like them for quite a long time. We could talk about derivatives and all sorts of complex financial contracts, but we've kind of had them since Mesopotamia. So on the one hand, we've got some of the most exciting things happening in the world, and the pace seems to be ever accelerating. But when you step back and you look at the things that are happening, they're all rooted in kind of institutional solutions that have been around for a long time.
Right. So if you look at that system, which is, I mean, if it's been around for a long time, and you look at it, what are the inefficiencies in the system that can potentially be addressed with fintech in general?
Yeah, I mean, finance is really all about information, right? The theoretical issues that finance professors spend all their time on are things like asymmetric information, adverse selection, moral hazard, what's called delegated monitoring. It's all about the informational interface between, say, borrower and lender, between payer and recipient. And so if finance is all about the generation of information and the utilization of that information for transactions, the rapid acceleration of information production, which is probably the single most important transformation that's happening in our time, is obviously going to hit finance almost more than any other area of economic activity. So it's really just about better information all around.
Give me an example of that. Maybe not. We'll get into cryptocurrency in a second, but what are some examples of that you're talking about?
Yeah, so I mean, even if we go back, say, 25 years ago to Capital One, right, when Capital One got started, the number of people who could get access to credit cards was quite limited. If you go back as far as the 80s, because anybody below a certain credit score was simply unable to get a credit card. They were viewed as being bad credit risks. And then along comes a company like Capital One, and there are others that are doing this, and they said, look, this fine-grained single cutoff of FICO score is way too blunt of an instrument. If we could get better data and learn things about the customer beyond just the FICO score, then we could probably find a bunch of people who are good credit risks who are buried in the denied credit bucket, and then some other people who are probably bad credits who are in the given credit bucket. And so it's all about going from these very crude classifications into much more nuanced and subtle ones. And for that, it's all about finding new sources of information and processing it more quickly and more effectively.
But we still use a FICO score, don't we? I mean, they just changed it up, but we're talking about 25 years ago. I mean, have they really done anything different or?
Well, companies like FICO have obviously tried to, improve their game and come up with better metrics, incorporating, more information and using better algorithms. But at the end of the day, they're limited in terms of the stuff that they access. They're looking backwards at, previous behavior. They're not looking at real time. What we want is real time decision making. I mean, I want to see your interest rate go up the minute you get off the plane in Las Vegas. You know what I mean? I want to see, I want to see the your credit line go up the second the inventory shows up on the loading dock, right?
Yeah.
This is what is now being enabled with what we call fintech is, real time decisioning, that's granulated down to the very specific person, the very specific action, and the specific moment in time.
Yeah, I mean, I just as a follow up on that, I remember finishing residency and going from, I was over there at UC San Francisco, and my surgical training, I think I made like $45,000-$50,000 in my chief residency year in San Francisco. You're obviously in the Bay Area, you know how far that probably went. And then the next year was making mid six figures, but my credit report was exactly the same.
Yes.
My FICO score was exactly the same, and it took a while for that to register. So
yeah, I mean, if you graduate Harvard Medical School with a bunch of student loan debt, to the credit provider, you just look like a horrible risk. I mean, they don't look at your LinkedIn profile. Well, now a lot of lenders are looking at stuff like that. They're scraping data from your phone to see, what do you do all day? Where are you going? I mean, even there's a lender in Africa called Tala, where they look at how frequently you recharge your battery on your phone. People who let the battery go all the way to zero are bad credit risks. And so, no, I'm seriously, so people who top it off periodically, they see it go down 20% and they plug it in. Those people are actually really good credit risks. I mean, your Facebook profile probably says way more about your creditworthiness than your FICO score.
That's interesting. So let's talk a little bit about the latest and the greatest when it comes to fintech, specifically in my what I'm referring to is distributed ledger technology. And let's start with Bitcoin. What are your thoughts on Bitcoin and its future, either as a storage of value or money or whatever?
Well, I mean, look, Bitcoin has a certain amount of kind of classic reputation going for it, right? Kind of like gold. I mean, there have been a lot of precious metals and other sorts of material sources of value store that have come about since gold, but gold has that iconic status, and I think Bitcoin will always have this iconic status. It's got terrible characteristics. I mean, it's never going to be a good medium of exchange, and it's never going to be the way in which we all transact our business, and it's certainly not going to be a unit of account. And there are obviously solutions out there to try and make it more scalable and lower some of the costs of transacting. There are ways of using it to store entire lists of transactions rather than single transactions. There's off-chain activity, which is then, I mean, I think you could imagine how Bitcoin could be like a central bank where you just have all of the net settlement across exchanges taking place. So there would be very few transactions actually on chain. So that's one possibility where Bitcoin continue to stay relevant. But we're starting to see a whole bunch of other uses of blockchain that I think will be far more important than Bitcoin. Just like in the grand scheme of things in the traditional financial system, gold plays a very, very trivial role.
Yeah, let's talk a little bit about the gold parallel though, because I think it's a good one. Because I think a lot of the purists around Bitcoin and I mean I think I would kind of put myself in that role too, kind of see Bitcoin as a type of storage of value that will ultimately become a digital gold. And what do you think now? Obviously, I hear what you're saying when it comes to day-to-day transactions and that sort of things, and there are people who think that Lightning Network and some of the other solutions around that will solve that. But even as a storage of value, what do you think would be some of the things that would prevent that from happening?
Well, obviously, if there's a 51% attack, right? I mean,
Sure.
one of the things that keeps the network functioning is the idea that it truly is decentralized and that you have the checks and balances, built in. What I find so exciting about the new developments in cryptocurrencies and blockchain protocols is the kind of people are starting to pay much more attention to consensus mechanisms, and this is, I mean, people have been studying this since the ancient Greeks, and people, Condorcet in the 18th century and all the game theorists in the 1950s and 60s, we've kind of brought our attention back to what are the conditions for what you might think of as constitutional stability. And in order for that to work, you have to have these checks and balances. And there's really nothing in place to prevent a majority of miners from simply taking over the network and appropriating value to themselves, in some form of seigniorage.
Yeah, but presumably that would require an enormous amount of money and resources to do 51% in Bitcoin in particular.
Not really, because people are already mining.
Are you talking about syndicates and that sort of thing, or?
Yeah, I mean, look, you don't have to increase the amount of mining to get to 51%. You just have to get 51% of the people to enter into a contract. And you could very easily enter into a smart contract which says, we're all going to cooperate, and if one of us doesn't cooperate, then they lose the whatever they stake. I mean, it wouldn't be that hard, actually. It would just require a little bit of kind of organizational entrepreneurship. Mm-hmm. And the number of miners that would have to get together for this are probably like 2 or 3 in China, and then boom, you've got a problem. So now, look, I don't think that they would behave like the Venezuelan central bank, and just. Yeah. I think that they would probably just have a nice, slow and steady 5 or 6% tax on everybody's Bitcoin every year, and that would be because they don't want to kill the golden goose, so they would just skim off a little percentage, a little tax. I mean, sovereigns have been doing this since the beginning of time. All the kings would, in the Middle Ages, would just say everybody's got to bring back their coins, and we're going to reissue new coins, and we're going to shave a little bit of the value off, and that's going to be our seigniorage. And there's nothing to prevent seigniorage from taking place in any of the cryptocurrency networks.
Yeah, right. Understood. I mean, I think that's it's an interesting scenario. Obviously, there are ways, there are various forks and things like that could potentially happen to avoid that in that event anyway. But let's move on to some of the other things that you were talking about. So, based on this, I mean, and the idea that, Bitcoin in particular, maybe not, in your view, something that that's going to sort of take over the financial world. What happens to it in the next 3 to 5 years?
Well, I don't think it's going to go away. I mean, I think that I think Bitcoin will. I mean, what I think is very healthy about what's happened in the last year or so is that all of this attention has been brought to it. But I remember in January I was in an Uber in Los Angeles, and then the Uber driver was rattling off all the coins that he was putting all of his life savings into, and I was like, all right, I got to get back to the hotel and see if I can short some of this stuff, because this was kind of like a March of 2000 moment when you have the hairdressers telling what stocks to buy. And so I think that was necessary to kind of get this on the map. But when the Uber drivers stopped driving the valuations, and it kind of goes back to sensible people that are trying to actually store value, then I think the price is stabilized. Then I think it's going to remain it's going to be there. It's going to be somewhat of a curiosity as a store of value. But I think that what people don't understand is that Bitcoin offers so much more, in the sense that if I want to encode information on this chain, I can do it. I mean, I can take an entire slate of transactions that I've that I've generated in a completely different world, and then I can just stick them onto one tiny transaction on the chain. And so that will always be, I think it'll be valuable because there's a network effect and there's a path dependence that kind of locks Bitcoin in as the most recognizable and universally accepted filing cabinet for all this data.
Right. I mean, you're talking about the sort of the non-monetary use of the Bitcoin blockchain in particular. Some of the developments.
And I think that'll keep the value. It'll keep some of the value going.
The other thing that's obviously happening in this area that I would think you would think potentially could be a stabilizing force, if not a more of a bullish thing about what's going on, is the the rise of the institutional interest in the space. With now you've got Backed being released by the Intercontinental Exchange, which is the owner of the New York Stock Exchange, is going to have they have 23 regulated exchanges. It creates a significant, global, if nothing else, some sense of security for institutional buyers. You've got the ETF that's sort of been put forth by the CBOE and partnership, and that's right. So this is clearly going to be something different than it is today. Would you agree with that, even in the sense of currency?
No, I agree, and it's great that the institutions are getting on board. But what we're seeing, I think, is what Friedrich Hayek dreamed of back in the 70s, where we have kind of a free market for money, and everybody's competing. But I don't think we should write off the central banks. I mean, they're competitors, and one of the reasons why these cryptocurrencies have emerged is because the central banks haven't introduced something similar. Now, I honestly think that in the next 10 years, we will have truly digital versions of all of the major currencies, meaning that, you'll be able to write smart contracts in Fed coin and Euro coin and Yen coin and RMB coin. And when you can do that, I think it's going to pose a threat. The question is, will the Fed be like Barnes and Noble trying to fight off Amazon, or will it be Amazon trying to fight off Rackspace? I mean, that's the question. And I honestly think that if the Fed does this, it poses a major existential threat to a lot of the cryptocurrencies out there. Ethereum in particular.
And why Ethereum?
Well, because Ethereum is what's being used for a lot of the smart contracts. But the problem with Ethereum is, of course, the volatility of its valuation.
Yeah.
I think and stable coin and the other kinds of attempts to introduce some predictability. Their business model disappears the minute the Fed shows up, because all they're doing is acting like almost like a currency board, right? And just like all the other currency boards, like Argentina's famous currency board in the late 90s, if there's no regulation on them, there's really no reason for them to exist.
Right. Although in the case of Ethereum, of course, it's not really a currency per se. I mean, it's it's really it's a protocol, right? So it's mostly used to build things on top of. So I don't know that the Fed would necessarily be a direct competitor in that regard. But let's talk a little bit about some of the other things. So you might be a little, obviously you're a little bit less optimistic about Bitcoin, but I know you are a believer in distributed ledger technologies in general. I've heard you reference, in particular, Nick Szabo's smart contract paper.
Yeah.
For those of you for those of us who may not know about that and what a smart contract is and why it's of value, can you comment on that a little bit?
Yeah. I mean, we talked a little bit about how the finance is really all about information, but it's also all about contracts. Finance is the economics of time. Excuse me.
Yeah, no problem. If you want to grab a drink, we can.
It's all about if thens. I mean, finance as well is pretty much all business, all economic activity, to the extent that it takes place over time, to the extent that it's not a spot contract. You're exchanging promises, and enforcing promises is why the legal system exists for the most part. If you can come up with a technological way of enforcing contracts that doesn't require the kind of oversight, doesn't require the kind of enforcement machinery, that doesn't require the monitoring, the weird forms of collateral, the ability to punish. If you can replace that with a nice clean series of computational if-then propositions, it really does solve a huge amount of problems in business.
So I think the best way to describe maybe a smart contract, as simplest example would be a vending machine, right? I mean, basically you've got a contract, you have a simple program in there, you put a couple coins in there, you come out with a soda, and if there's change to be made, the program knows exactly what you need. So what else could you replace? I mean, if you think about that, I mean, obviously it sounds like pretty much anywhere where there's potentially a middleman.
Yeah, well, I mean, the middleman, oftentimes the middlemen don't appear until the contract goes south, right? So, you and I could write a contract, and then if something happens, then we have to bring in the lawyer, okay, or the courts, or the repo man, or
Right.
the guy with the weapon. So we can get rid of those middlemen ex post and get rid of the ex ante middlemen who will set up all the. Now, look, I mean, we still need the programmers, and they're going to perform the role that a lot of the lawyers play today, and we probably still need lawyers to guide these programmers. But anytime you have a contract that can be reduced to a series of simple if-thens. So I think that the case where I think the hugest opportunity is in the world of high finance, in the world of derivatives. The scope of the derivatives market is 10 times that of the global economy in terms of notional principal. We're talking about swaps for the most part, but also, options, futures, all of these contracts. They basically take the form of if the yen goes up, you pay me. If the yen goes down, I pay you. Right? If the floating rate goes above the fixed rate, I pay you. If it goes below the fixed rate, you pay me. I mean, these are like they're called arrow de Brue securities or arrow de Brue contracts. This is easiest thing in the world to put into a smart contract, once you have the machinery for it. And that's going to just sweep away, entire universes of natural language contracts. A couple other areas have to do with SPVs. SPVs are classic. They're not quite as big, but anything where you have securitization, anytime you have cash flows that get sent to a special purpose vehicle and then sent back out to various claimants. All of this is basically a financial vending machine. If the cash flows come in, they go this way. If they don't come in, then this guy doesn't get paid. If there's a lot of them, this guy gets paid and this guy gets paid, and it's all just a bunch of if-thens. And we have lawyers that are doing all this and supervising all this, and we could do all this stuff with smart contracts.
What do you see the threat, if any, to investment bankers, venture capitalists?
Well, look, investment bankers are like I almost said cockroaches. Let's say they're like mammals.
Yeah.
We've reinvented ourselves many times since the Ice Age. So investment bankers will continue to exist, and they'll just keep going out on the next limb. But a lot of what they do now, and certainly a lot of the stuff that the transactional lawyers do right now, will be automated. I mean, I think JP Morgan just announced that they had taken 300,000 lawyer hours and compressed it to just a few microseconds of computation. We better get used to that, because that's what the smart contracts are going to do for a lot of these lawyers. But the truth be told, it's the most uninteresting aspect of the job of investment banker or lawyer that will be automated. And the more interesting bits will just get more and more interesting.
Do you think the New York Stock Exchange will exist as it currently does in 20 years? Well, in other words, will we be using a system that requires, the central ledger, the central authority to trade equities?
Well, I won't comment. Let me step back a second. Absolutely not. First of all, it will. I would turn the question on its head. I think what we will see is, in some sense, a greater centralization of information. So that word central, we have to be careful about, because right now we have lots and lots and lots of little ledgers, right? We have all the brokers have ledgers, the exchange has ledgers, the custodians have ledgers,
Right.
There's so many ledgers out there. And, reconciling them all is why we have accountants. And all they do is spend all day making sure that, when something goes from here to here, all those ledgers, reflect it. Now we will have a single ledger. Now, granted, it'll be distributed on all of these different, with all these different computers and all these different entities, but it will be a single ledger. And that single source of truth, even though it's distributed, will wind up putting a lot of these entities out of business. I mean, the exchanges will still exist, because we still need places where buyers and sellers can come and exchange things, and where prices can be discovered. But all the back office, all that machinery that happens behind the scenes that that takes 3 days for a trade to, be cleared and settled, all that stuff will just be gone. And then the question is, who's going to control it? Are the people who are currently doing this going to get wise to it and be the ones that create it? Or will the people kind of in further downstream be the ones that get together and create it? Yeah, but whoever does create it is going to put a lot of people out of business.
Well, I think there's, at least even within cryptocurrencies, obviously we've got this movement of decentralized exchanges. And so I wonder if, that kind of peer-to-peer transaction in what we consider sort of the traditional equities world would be the new. It certainly would save a lot of people money, except for the banks. But even
hold on a second, right? So, almost all of us who have cryptocurrencies, we fork over our private key to an exchange, and then what that means is that the exchange is actually the ones that are the custodians of the cryptocurrency, and so we use that word decentralization, but in fact, as soon as people get the decentralized asset, they can't wait to put it back on someone else's balance sheet. They can't wait to centralize it back, because the convenience of using an exchange.
Well, that's certainly the case now.
Yeah.
I think of the big ones you're talking about, like Binance or Bittrex
Coinbase.
or whatever, or Coinbase. They're all centralized, but I mean, we've got an entire movement of decentralized exchanges coming out, where basically your money is sitting right on the blockchain, and you're just talking about peer-to-peer transactions. So the technology is certainly there, and I just wonder if that's going to be something that we're going to see in the in the mainstream.
I mean, that's a great question, but I'm kind of a realist about people, and people are like, man, privacy. I need my privacy. And then someone says, hey, give me all your personal data for a free slice of pizza. And people are like, right. Sure, here it is. And then they talk about privacy. Like, no, if people really, really cared about privacy, they wouldn't use Amazon. They wouldn't use Google. They wouldn't use Facebook. Of course they don't. And so they use these things. And I think that a lot of people are like, yeah, I want to be in control, and I want to, use these centralized systems. But the minute you add in even the tiniest bit of convenience, people rush to take advantage of it.
Yeah, I mean, to your point, I mean, I think that's the thing right now that is the limiting aspect of decentralized exchanges. I mean, if you're going to end up, using MetaMask or some of these other things that are really, frankly, quite hard to use. But we've got some really interesting things coming along the way that could even simplify that, and you may not even be able to tell the difference now, even though you're on a decentralized exchange. From a historical perspective, again, going back to sort of your, the broader perspective that you have, when you look at distributed ledger technology, whether that's, blockchain or gossip protocols, whatever it ends up being, in terms of financial and the business world, how big is this technology? Is it PayPal, or is it the rise of the internet itself? How big is this?
I think it's closer to the latter. I mean, I think we really will, and I'm not looking at it through the cryptocurrency lens. I'm looking at it through the database lens. I'm looking at it through kind of the way databases have evolved over the last couple decades. We all have moved from these on-prem databases to cloud. We've moved from kind of relational databases to these data lakes, and you've seen how as every business has become a data business, and every business has really had kind of some data strategy at the core of its business model. Any developments which facilitate better access to data, better communication of data, better codification and retrieval of data, better harmonization of data across not only firm boundaries, but across, different divisions within the same firm. It's truly transformational. I think, it's kind of, I would say it's up there with machine learning as, in terms of the impact that it's going to have.
I would tend to agree with that. So how can we learn more about what you're working on there without going to Berkeley?
Well, so I'm in the process right now of developing an online course in collaboration with some other folks here at the business school and the law school and the engineering school, that will take some of the the stuff that we give to our MBAs, to our JDs, to our engineering students, and just make it available to people on a broader way, and hopefully that'll kind of create more buzz, generate more community, particularly among enterprise people. I think that although the folks leading the charge have been students and people on the fringe and entrepreneurs, it's just really important for people in mainstream enterprise to understand that this is something they need to know about. And when the CEO says to the CFO, "Hey, I read about blockchain. What's our blockchain strategy?" I would hope that the CFO doesn't just make something up or provide some nonsense or cut and paste something from IBM, but rather really has given some thought to it, and whether it's the CIO or the CFO or the CTO or the CMO, like they all need to have some understanding of how their world is going to change and what the opportunities are, so that they don't get left in the dust.
Yep, absolutely. And it can't be just putting blockchain on the end of your name of your company, right?
Yeah, right. Yeah, I know. Why didn't I think of that? I should have changed my last name. I would have.
your stock would have gone up by about 25%.
That's right.
With that. Well, anyway, listen, Greg, I really do appreciate you being on the show and adding your perspective.
Well, no, thank you so much for having me. And then one day maybe we can talk about asset management, because that's another area that's really dear to me, and I think that world is being radically transformed as well.
Yeah, I'd love that. Thanks for being on. We'll be right back. Okay, welcome back to the show, everybody. Now it's Q&A time. I'm sure you enjoyed that talk with Professor LeBlanc, and he's very generous with his time. There are some things I want to talk about which he mentioned, which you might have been wondering about, which gives me an opportunity to answer some questions about things that maybe we have not discussed on the show so much yet. So let me ask the first question instead of having you do it. You heard Professor LeBlanc talking about a 51% attack, and I think specifically he said that he didn't feel that it would be that difficult to do. So let's move back. What exactly is a 51% attack in the first place? So one of the things is, and I'm going to keep this very basic, but the people with the power in Bitcoin or other blockchains are what are known as the miners, right? They're the ones who are doing this. They're doing these complex mathematical problems through their computers, specialized computers, and that is called mining, right? And think of all of that mining power, all of that power that goes into this is something called hash power, right? So if you are able to get 51% of the hashing power, then you effectively can do something nefarious to a blockchain. You can't do that to anything in the past, but what you can do is you can actually double spend money, double spend Bitcoin. You can spend it and then, because you control the blockchain, you can basically say, I haven't spent it, but in the meantime, you've already bought something with your Bitcoin. So that is extremely simplistic about, a description about what a 51% attack is. But that's what it is. Effectively, 51% of the hashing power gets together and decides we're going to double spend and make a bunch of money on this. And so when Greg LaBlanc says that he believes that this would not be particularly difficult in the case of Bitcoin, theoretically, there may be some truth to that. After all, in Asia alone, right? I mean, I think they have 70% of the hashing power coming out of China. But let's talk about why that is not likely, because I disagree with Dr. LeBlanc on this point. If you got in this situation, first of all, these miners, right, the ones with the hashing power, are spending billions of dollars on these fancy computers to do this mining. It is in their best interest for the Bitcoin ecosystem to stay intact and for them to continue to accumulate Bitcoin. Hopefully that makes sense, right? Because what would happen to Bitcoin if there was a 51% attack and all of a sudden there was a double spending problem? It would destroy Bitcoin. And what I mean by that is there would be a complete lack of faith in the Bitcoin network. And do you really believe that people who've spent literally billions of dollars on Bitcoin mining equipment are going to suddenly want to see Bitcoin go to zero? The answer is no. This is akin to what is called mutually assured destruction, right? That was the whole idea back when there was the United States and there was the Soviet Union, and if one of them pushed the button and started a nuclear war, it would basically create annihilation of both sides. That's why it can't happen, okay? The Bitcoin miners have billions and billions of dollars in these machines. They have zero interest in seeing Bitcoin go away and having all of those computers that can do nothing other than mine Bitcoin become completely worthless. So I would respectfully disagree with Dr. LeBlanc on that. The other thing is, along that line, is that there is no ability for miners to suddenly start taxing anybody. I mean, that's just another sort of software issue. There's not like a government, right? The miners are not government. All they do is create Bitcoin, and they basically create algorithms. Another issue I needed to just address again, and this is just, giving you my perspective because I think it's important, and we're all learning here. And I certainly don't pretend to be the expert in any of this, but I want to make sure that I give you my perspective as well. There are, Dr. LeBlanc also talked about some of these exchanges and how there's, basically you're taking centralization away. You're going to decentralize Bitcoin, but then it gets centralized when it's back in, like a Coinbase or a Gemini or Kraken or something like that. And while that is true, there is a couple of things to remember. Most people who own a lot or a substantial amount of cryptocurrency, or people who don't even, but just kind of get it, they don't store their cryptocurrencies on exchanges. They store them in wallets, right? And the wallets are, in fact, not centralized at all. Certainly, you could keep your money in Coinbase, right? You could keep your Bitcoin, your Ethereum in Coinbase. And in that situation, your money, your currency is still on the blockchain, but it's mixed in with everybody else's, and it's basically prone to attack because anybody who can get into the exchange's funds is able to basically rip off all of your tokens. Now, if you have a private wallet that you're, like, for example, say you're using my Ether wallet or something like that, that's sitting on the Ethereum network, right? You need a private key to get in there. It's not centralized. So that is not true. When you are storing your own coins in a wallet on the blockchain, it is not stored in a centralized area. So those are a couple of things I think that are important. By the way, I recommend Ledger Nano S, which is what I use. And I think Phil has a tutorial on how that works, and maybe a link on that on consensusnetwork.io. Okay, so now I'm going to go to a couple of your questions. The first one is from Amit. Amit says, hello, Buck. Enjoying this new podcast. The crypto space is very fascinating. A few comments and thoughts. One, you mentioned you are bullish on crypto as an investment. Are you talking specifically about Bitcoin or other types of cryptos? So I am bullish on all of distributed ledger technology. But let me take that question. It's a good question, right? Because the way I think about investing in this space is I actually think about it as two things. I think about it as Bitcoin, and then I think about it as everything else. Because Bitcoin is the one thing that has already been accepted by mainstream investors vis-a-vis Wall Street as a storage of value, as a type of digital gold. So I think the risk profile on Bitcoin is different from the rest of the tokens and coins out there because of this adoption into mainstream elements. So I'm bullish on all of it, but I think if you're wanting to get in and you want some upside, but you don't, you're not, you want to be a little bit maybe minimal in terms of your risk taking, probably just stick to Bitcoin, because we know Bitcoin is what Wall Street's going to buy. Now, I know people out there are thinking, well, Buck, what about you've got Ethereum, right? You've got, all these other things out there that are, in the top 5 or 10. But I think with those, I think the challenge is, and I'm not against those. I own a lot of different, cryptos. I think something like 40 different cryptos, but they're all, the rest of them are all on the scale of a little bit more speculative in my opinion, because even Ethereum, right? Ethereum is a tricky one. I know everybody is so Ethereum's is solid as Bitcoin, but the challenge with Ethereum, in my view, is you've got these competitors, right? You've got these next, what is Ethereum? Ethereum is basically It's a protocol, and it's something that people are going to build applications on top of. Okay, and it's a first of its kind. That's why it's a big deal. But unless they can significantly improve that technology and make it more scalable, you've got a whole lot of other options coming up through the pipeline, namely EOS, right? EOS. Another one of my favorites is Hedera Hashgraph, which has not released their token yet, and it's actually not a blockchain protocol. It's a distributed ledger called a gossip protocol, and you're going to hear more about that in the future. But you've got all these other different protocols on which people can build things and have smart contracts and all that, and they're a lot more scalable. I'm not saying that Ethereum is dead by any means, but on the other hand, it makes me less sure, I guess. I mean, you can never say anything sure, right? But Bitcoin to me, I was definitely not necessarily a Bitcoin guy when I first got into this, but now I'm looking around and I'm saying, we've got mainstream adoption of Bitcoin. This is different from all of the rest of blockchain and crypto right now. So that's how I see it. But overall, your question being, am I bullish on, what am I bullish on? I'm bullish on all of it. You know, all of the good projects and Bitcoin, but they're different. They have different risk profiles. Okay, second part of that question, there's a 3-part question from him, is you mentioned that you'd like for Bitcoin to drop to around 6,000 before you invest again. What's the rationale for this if you think it's going to jump up in value in the future? Well, my rationale is this, okay, is I already own Bitcoin. I own a fair amount of Bitcoin. And so really what I'm looking for is I'm looking to add to it at values that I think it's on sale. I think right now, as of today, it's about $6,500. And if I owned no Bitcoin whatsoever, and I knew, or I felt, you know, the way I do, I would go in there and buy right away. But right now I'm opportunistic. If I don't buy any more Bitcoin and it shoots up to 20,000, I'm happy. But if it drops down to 6,000, I feel like it's on sale. Now, why? You might wonder why I think that. Well, a lot of it has to do with, I'm not a trader, right? But I follow some of these charts and things that other people write about. And if you look at what these supports are, there's a really, really robust support when Bitcoin drops to about 6,000 or so. It can drop a little bit below there. It can go to 59, 58, but man, there are so many buyers at that point that it won't stay there for long. So I am basing that a little bit on some trading principles, moving averages, etc. I don't, you know, I will point out that I did buy some more at around 61, about 61.50 last week. And had I seen it drop below 6, I would have jumped, but I was in the middle of something else, completely unrelated for that day. So I missed out, but I did buy around 61.50. And I think it's still a great value. The third question from Amit is, I get you're not a financial advisor. Thank God for that, I'll tell you. And we should do our own due diligence. But for someone looking for set it and forget it is type speculative investment, what are your thoughts on dropping $1,000 on Bitcoin and hoping for the best? Would you suggest spreading out amongst the other currencies? I will say this, man. I think, again, if you're just talking, it depends how much money you have, right? Bitcoin is in all of these coins and tokens are definitely speculative. But I personally, again, I'm not an investment advisor. I'm a guy with opinions, and but in my opinion, as an investor, knowing what I know, what's going on, I think Bitcoin is not even risky as everybody has to say it is, right? Every time somebody talks about Bitcoin, everybody has to say, oh, but it's risky and be prepared to lose everything. Well, hello, that's called investing, right? But right now, Bitcoin, in my view, is not terribly speculative. So dropping on Bitcoin is probably not a bad move to do. But on the other hand, what I would say is, in terms of you saying, if you want to spread it out amongst other currencies, I would tell you that unless you're in this space, unless you're really looking at projects, etc., don't even bother, because you're going to end up probably losing money. And, again, I am pretty, in the space. Listen, I'm doing a podcast on this stuff, 2 podcasts a week. That's more than I do for Wealth Formula now. So I feel comfortable taking some risks because I know what I'm doing. But I think for most people, if you want some exposure, there are some funds out there for accredited investors. Looks like you said you're not accredited. We'll have some of those people potentially on this show later on and talk about those things. But yeah, I think if you're gonna, if you just want to do a set it and forget it, Bitcoin would not be a bad idea. All right, next question, and then maybe we'll wrap it up because I've been talking for a while here. Sean writes, "Hey, by the way, everybody, tell me where you're from, okay? Because that'll be fun to know. Because some people are from everybody's from different states, but sometimes you get different countries, etc. So make sure you let me know. And again, you can do these via the voicemail or SpeakPipe or whatever you want to call it, consensusnetwork.io, so we can hear your lovely voice on the air. So anyway, Sean writes, "Hey Buck, I've been enjoying the new podcast. I've been looking into this space for a while. My question is, how do I, as an accredited investor, purchase a private token like Hedera? I'm with you on Hashgraph and the speed it is capable of and would love to get in on the ground floor of this thing." Well, so you're an accredited investor, which is good news. The bad news is in terms of Hashgraph, you've missed it. So there used to be, there still is. There's something called an initial coin offering, and or a token generation event. You might hear that term as well. But what these are is they're basically IPOs for cryptocurrencies, right? And the difference is that it's just like it becomes like a technology game. Like whoever can get their money in first. And there's a bidding war, gas war, as we call it, for Ethereum. And people are just trying to buy tokens, and it cranks up the prices right away. That was called an ICO. And they still exist. The problem is that the Securities and Exchange Commission in the United States does not like them because they consider that akin to an initial public offering, as you do in the stock market, which requires you to be an accredited investor. An accredited investor is somebody who makes at least $200,000 per year, $300,000 if filing jointly, or has a net worth of $1 million outside their personal residence. So if the SEC is saying that ICOs are not, they're basically, they're IPOs, then they are illegal if they are not limiting to accredited investors. So there's a lot of scrutiny on that front. And so effectively this year, they've pretty much ended doing any initial coin offerings, ICOs, in the United States. So you don't really get to see that. Now, if you are accredited, and again, accredited is, you either are or you aren't. It's like being pregnant. It's not something you apply for. If you're accredited, you just have to be tapped in and know when there are pre-sales going on. So you mentioned Hashgraph, Hedera Hashgraph, which I'm excited about, which I did participate in the pre-sale. And the way it worked basically was there was an institutional round, and then they came to retail accredited investors, and they basically, you had to prove, you had to be on their site. You get you end up getting some kind of an email from Hedera saying, okay, well, if you're interested, you have to prove to us that you are an accredited investor. So you have to go there, you have to fill out some paperwork, get information from your accountant saying that you're accredited, a third-party verification, and then there's all sorts of know your customer things, like sending a a picture of you with your passport, things like that, to make sure you're not a money launderer. Once all of that's said and done, then you get put on a list, and this is basically what's called a SAFT, or a pre-sale. It's basically a sale of a future token, SAFT, and then so you just basically pay for it. It's a pre-sale. It's no longer an ICO. And then when the tokens are actually generated, the company sends you the tokens to your wallet. Now, that's how it currently works. If you're interested in a potential project that that's coming up, that's not in existence right now, and you live in the United States, unfortunately, ICOs are just not really something you can do. And arguably, any company right now who is doing an ICO may not be reputable, because I think a lot of them are interested in trying to stay above board. So they're sticking to pre-sales. So I'm sorry to say, but it's that whole reason the rich get richer, because people who are not accredited do not get to participate in these things in the United States. So if you are accredited, how do you find out about this stuff? Well, you basically got to be following a lot of people. You got to know a lot of people, and you got to find out about new projects. And then you start hearing from insiders that everybody's getting excited about this, and you say, hey, I want to learn about the project. And then you go to their website, and a lot of times they'll have something that you can sign up to get notified when the pre-sale is going to happen. That's basically how it worked. That's how it worked for, what was it? There was one that was issued from overstock.com. I forget the name. But anyway, they had one of those as well. These SAFs are becoming much more commonplace. Hopefully that answered your questions, and I'm sorry you missed out on Hedera. But, as soon as I think their tokens are coming out in Q4, so it's still, something that you're almost certainly going to be able to buy on Binance probably very quickly. They didn't say that. I have no information on that. It's just every major token that comes out, seems to immediately go to Binance. So if you haven't got a Bittrex or Binance account, get those two. At the very least, I think those are very smart to get, because those are the ones that are probably the most legit. By the way, one other thing I want to mention is going back to the conversation with Greg LaBlanc, was we talked about the centralization of those exchanges, but that's actually not even necessarily something that has to be the case either. And so if you look right now, if you look up ZRX, I think it's getting listed on Coinbase. What you'll see is there is, that's one project. There are multiple other projects that are coming through. There are some distributed exchanges already. They're not easy to use, but that's going to become much more common as well. You're not going to necessarily just have like the Bittrex and Binance and Coinbase that are owned by one company. You're going to have distributed companies that basically become peer-to-peer trading sites. And so that's another thing. This whole world, it can be distributed, and that's the message you need to take home. Anyway, that is it for me this week on Consensus Network. This is Buck Joffrey signing off.